perspectives perhaps you've never considered.
And good morning on this nice and warm Friday morning. This is the last Friday in March, and we're very pleased to be with you. We're coming to you via Zoom. I want to emphasize the fact that as our new theme, Profiles and Perspectives, we are truly looking to profile interesting people and offer up perspectives perhaps you haven't considered. And I want to encourage you, if there's someone who you believe would truly be interested in profiling, I'd love to know about them so we can work to get them on the show. If you, in effect, do know folks, profile.perspectives@gmail.com is the email address, profile.perspective@gmail.com. I'm pleased to have my resident economist who is joining us uh, this morning, Professor Dr. Matthew Dobra. He's the chair of the Accounting and Financial Economics Department at Methodist University. Good morning, Dr. Dobra.
Thank you for having me. Great morning to you as well.
So we do this, I guess probably attempt to do this quarterly or something like quarterly to talk about and bring some common sense, plain language insights for people about what's taking place in the U.S. economy and in the global economy. And as I typically do, I kind of offer up a set of questions. And what was interesting this morning, that you indicated that the themes here are the same, and in your mind they kind of tie back to all of the impact of what took place economically during COVID.
Yes, sir.
And so before we jump into the specifics, let me just give you the opportunity to talk about, when we talk about the current economy, we've got inflation, we've got bank challenges, bank failures, we've got what's happening in terms of, is the economy growing, is it going to be in a recession? How does all this tie back to some of the decisions that we made during COVID?
So as we start talking, and I know that I know you have on your mind because you sent me an email about it, but I suspect that anybody listening has on their mind, there's a lot of weird things going on with financial markets right now. Financial markets with regards to banks basically having bank runs on them in a way that we haven't seen in decades. I think three big time banks have fallen apart in the last 2 weeks. We're still living in this era of inflation. And it turns out that, and we'll get to this story later on, a large reason why these banks are failing is because of the way that the government is responding to inflation. The fight against inflation is the cause of bank failures. Well, why do we have inflation to begin with? Well, we have inflation to begin with because 2 years ago, the government responded to COVID by putting a ton of money into the US economy. And that's the ultimate source of inflation. And I've been on your show pretty much throughout all of COVID. I think the first time I came on your show was like June of COVID. And I know even then I was, the canary in the coal mine saying this is inflationary if they don't slow down, if they don't, if they're afraid to turn off the sort of the welfare spigot in a sense, the bailing out of companies, the PPP loans, the stuff like that. And it took about a year, which is probably 8-9 months too long. And they ramped it up instead of turning it down first. And so all of that culminated in the high rates of inflation. And then, when the government was saying all through 2022, at least at the beginning, oh, inflation is transitory, so we don't need to do anything about it yet. They did this sort of wait and see thing. The wait and see thing meant that when they actually got around to tackling inflation, they had to do it fast instead of slow. And so the speed which what they've been dealing with inflation by raising interest rates by nearly 0.75 percentage points at a time is one of the things that really fundamentally undermined the banking sector. So I know I threw a lot at you there.
Yes, and that's perfect. So we'll just slow down and we will unpack it. We're going to unpack it.
Absolutely.
So there are three banks that have been in significant distress. Two of them actually failed, and one of them was propped up. So Silicon Valley Bank went under.
Yes.
I believe that was listed as the largest bank failure in history, if memory serves. If not, it was close. Uh,
Sounds plausible. It's not right. Yeah.
then you had Signature Bank go under. And then when the two of them went under, you then had a run on a New York bank called Republic Bank. So let's talk about the idea of a run. So you
Yeah.
said, hey, there's been a run on the banks. What does it mean for there to be a run on the banks?
Yeah. Minor correction to what you just said because it
Yep.
turns out to be important in the story. Signature is a New York bank. First Republic is a California bank.
Okay.
But New York Bank does have a lot of exposure to the same markets that these California banks have exposure to.
Okay.
So they're even though they're the geography things kind of matters a little bit. It's really the industries that they're all very heavy into that turns out to be part of the problem.
Okay.
All right. So a bank run. Man, this is going to be hard to not be wonky.
We'll work through it together because I mean
All right. You're asking for, a half a semester of my macro class, 20 minutes for it to make sense. Like, this is a lot, man. Okay, so a bank run, a bank has assets and liabilities, all right? Just like any business. An asset for a bank is like a loan that they've made that money's going to come back in the door for, right? The asset is there the stream of revenues coming back. They might own buildings, they might own stock, right? Those are their assets. A bank also has liabilities. A liability is what they owe to somebody else. You, the depositor in that bank, you to them are a liability because if you come and ask for your money, they've got to give it to you. All right. Normally, normal accounting, you have assets that are equal to liabilities and everything's hunky dory, and that's great. But that's not always the case, right? And when it's not the case, a bank is said to be bankrupt when their liabilities are bigger than their assets. Now, how does this tie into the idea of a bank run? A bank run happens when people think that the bank is going to go bankrupt and they are not going to be able to get their money out of it. So this is not something that well, you probably do better than I do. I don't have to worry about this, Dargo, because I don't have enough money in any bank that a bankruptcy of a bank is going to cause me any trouble. If I've got my money in a bank and I have less than $250,000 in that account, and the bank goes bankrupt, I still get my money. That is how the FDIC works.
right, and that's
Uh,
because the government through the Federal Deposit Insurance Corporation guarantees all deposits up to $250,000.
Absolutely. And part of the reason I'm throwing this out is that I don't want people listening to this to start freaking out, right? Most people don't have a single bank account with $250,000 in it. And so if that's you, that's definitely me. You don't need to worry about a bank run. However, if you're not doing a great job of managing your assets and you've got a single bank account with $152 million in it, like Roku did, or Circle had like over $1 billion. Roblox, that's a game your kids might play on the Xbox, right? That one had they had $100 and something million and they're just sitting in their bank account. If the bank goes bankrupt, that is not insured. And so these companies were worried if this bank goes bankrupt, I'm not going to have any ability to get this money out of the bank. And so if you're worried the bank is going to go bankrupt, you go get your money out right away.
Right.
But here's the problem. Banks don't just sit on your money, right? There's not some dude in the back who's got a big throne made out of cash. He's not just sitting on it, waiting for you to come back and grab it, right? They're doing something with it. They are investing it. They are lending it. And so SVB, I think they had something like $200 billion in liabilities, meaning that the $200 billion worth of deposits had been made into their bank. And they weren't holding on to $200 billion, right?
Of course not, because they had to make a profit, which means that they had to invest it in something.
Exactly. And so they might have only been sitting on in their bank, 20 billion or 30 billion. And when people started flooding the thing saying, I want my money, and they said, oh, we don't have enough money, then they had to start selling off assets in order to get money to pay these people the money that they're owed, right? So Darswell with his, big tech companies like, hey, I need to make payroll this week. And they say, I'm sorry, we're out of cash. You're going to be a very sad panda. And guess what? You're going to tell all your buddies that you need to get your money out right now because they're running out of cash. And then everybody went to get their cash at once.
So,
And that led them to be forced to try to sell off.
yes, and so so at the end of the day, if you were to say that the confidence that the customers had that the bank was going to survive, when you lose that confidence, people say, "Well, let me take my money because I'm not sure you're going to be around." And their decision, kind of all at the same time, to go and get their money is what causes the bank to fail. If people continue to have faith that at the point in time that they needed it, that the money would be there, well, then the bank would be perfectly safe. And the reality is that the entire banking system is based on that sense of faith and confidence. Because there's not a single bank that is sitting on the money. If everybody wanted their money, the entire system would collapse.
Yeah, that is true. And part of the reason why the FDIC is there is to try to prevent that from happening, so that normal people don't go run and get their money. It's in this case, it only happened to SVB because almost all of their deposits were big giant tech firms that did not get this sort of insurance. And that's where sort of First National, and I might have butchered the name, and Signature sort of have in common is that they are very big in the tech sector.
Yes.
And what's sort of unique about the tech sector is that these businesses don't make money. They spend money, and money comes in through venture capital, right? Most of these are not terribly profitable. And so they are constantly just pulling money out. Right. And if the venture capital dries up, that's going to mean that they're just sort of in a constant state of withdrawal.
So ultimately, what happened here, and I hope we haven't lost too many folks here. Ultimately, what happened here was the Federal Reserve, which is the lender, it's called the lender of last resort, meaning that they are the backstop to maintain stability in the banking system, went out to some of the major banks in the United States after they allowed Silicon Valley to fail and then Signature started to fail. They recognized that confidence in the overall system was at jeopardy. So then they went to the major banks with J.P. Morgan, my former employer, Jamie Dimon, and others, and they got them to put $30 billion worth of deposits into Republic. So this was a situation where the Federal Reserve could have stepped in, but they needed the banks themselves to demonstrate confidence in the system. So they asked the banks to, hey, I want you, because if J.P. Morgan and Goldman Sachs and Bank of America put money into Republic Bank and Republic Bank goes under, they lose that money. So they're saying we trust Republic Bank to survive. By us putting billions of dollars in there, we're saying we trust them to survive. And as a result, it created a sense, well, you can tell me, what sort of sense of stability did that create in the banking system?
I want to apologize real quick. I misspoke. I said First National. I meant First Republic. So
yes.
I'm
calling Republic. I'm calling Republic because there's a Republic in New York, so it's First Republic. So we're both a little bit butchering that name because I'm thinking it's the Republic in New York, and you're telling me it's the First Republic in California. So we're both a little bit off kilter this morning.
We'll get there. This is not financial advice. Be warned.
Absolutely not.
Yeah, I think it does help in terms of creating some confidence in the banking sector. But I think there's a different interpretation that I want to offer with regard to why it's the banks and not the Federal Reserve. The Federal Reserve right now is fighting inflation like crazy. All of these actions that they're taking to bail out banks is inflationary in its very nature. So if the Federal Reserve was to start bailing out the banks, and they've actually said they're going to, like they've opened up this new sort of, I forget what it's called, but it's like this new bank loan window where they're going to buy all these assets at face value. And so these banks don't lose money. That is inherently inflationary. And so the cause of all of this, and so we haven't talked about why the liabilities fell at all, and that's a little bit wonky. That might have to happen after a break, if it happens at all. But the cause of what's going on is interest rates going up. Interest rates going up are to fight inflation. To bail out the banks is essentially unwinding the sort of pushing up of interest rates. And so the Fed is in a tricky situation because for the Fed to take action, it would undermine all the things that they're doing with regard to inflation. And so what they're really fighting, and is a thing that you guys are going to hear in the news very, very soon, is stagflation.
Ah,
The concern that we're going to be very soon in a recessionary environment with high inflation at the same time. And that's like the worst of all possible economic situations, because inflation is bad and stagnation is bad. And then boom, you put them together in a railroad of mishappiness. That's not even a word, of stagflation. But that's basically the economy of the 70s in a nutshell.
so if we were to go back here, and I want to hopefully bring this away from, you're calling it wonky, back to something that people maybe can wrap their heads around a little bit better. We have established the fact that inflation is when prices are rising faster than we'd like them to. The Federal Reserve, which again
Yeah.
is really the person who controls the cost of money uh, in the U.S. economy, had a goal. And correct me if I'm off of here, but they were saying 2% increase in inflation per year was kind of their target. And
2% increase in prices, which is the same as inflation. Right.
okay, thank you.
So
2% increase in
absolutely.
prices, which at the end of the day is the same thing an increase as an inflation rate of 2%. But the inflation
Exactly.
rate had gone was over 7%, even higher, perhaps at certain points in time.
9.1 is where I think it peaked out. I want
Okay.
to say that was
So
late
if you want to be at
2018.
2 and you're at 9.1, clearly you've got some major work to be done.
Absolutely.
And this increase in inflation was because there was a lot of extra money in the system
Yes.
that can be attributed to the money that was given to companies and given to individuals during the COVID shutdown, where they were giving people money to not work.
Yes.
They were giving companies money when they were shut down.
They were giving money to companies when they were shut down to not fire workers.
To not fire workers.
Yeah. They would have to pay it back if they fired people, but if they
Yes.
didn't, it was
And so that spike, and then the question of, to your point when you started, was at some point they needed to stop that spike and say, okay, this is enough. The government continued to put more and more money in after they probably should have stopped if the goal was to not have inflation.
right.
So here's what we're going to do, because we're here at the bottom of the hour. We're going to take our break. When we come back on the other side, what we want to do is we want to talk about what is the Fed doing in terms of controlling inflation right now. And I want to challenge some of the strategies that the Fed is using, because their typical approach hurts workers, because their goal is going to be to stop is to have a company. In effect, what they're going to do to slow down the economy, they're going to slow down employment. They want to, if you will, push people out of work as a means of doing that. And we want to look at that as a strategy, and what else could we do other than, in effect, create unemployment to slow down the economy. So when we come back from the break, that's what we're going to do. You're listening to Profiles and Perspectives, and I've got my guest, Matthew Dobra. He's the chair of the economics and financial of the accounting and financial economics department at Methodist University. We'll be right back. And welcome back to the second half hour, Profiles and Perspectives. I'm speaking this morning with Dr. Matthew Dobra. He's the chair of the accounting and financial economics department at Methodist University. Before we jump back into our conversation, I just want to make a quick announcement here. There's going to be a rally this morning at the Cumberland County Courthouse at 11, and it deals with the fact that we've had a significant increase in teens stealing guns out of vehicles and then using them in obviously in crimes. According to the Fayetteville Police Department, there were 1,200 auto break-ins last year, and 1,200, and they recovered 100, and they got 154 guns in those break-ins, which is about a 13% of all break-ins. They secured a gun. There has been a proposal by Councilwoman Brenda McNair that we require people to secure their gun in their vehicle. This is just a question of, if you're going to have a gun in your vehicle, that you have secured it in some way whereby if someone breaks into your car, they just can't take it because they're ending up in these crimes. What's notable is half of the vehicles were open. They weren't even locked. So you've got people with an unlocked vehicle and a gun that somebody can just pick up and walk away with. So there's going to be a rally, and this has been kind of sponsored by the Cape Fear Fayetteville Association of Black Social Workers. And this deals with teen violence. So it's going to be at 11 o'clock on the county courthouse steps. If you can make that. If you can't make it, can you at least communicate to the city that you would like there to be some sort of ordinance that would require someone who has a weapon in their automobile to have to secure that weapon so that these don't end up in the hands of people who are committing crimes. All right. And so with that, let me pivot back to talking to Dr. Matthew Dobra. We're talking about the dynamics that are taking place here in terms of inflation, why inflation is taking place. So let's start this, Dr. Dobra. Right now, where is the inflation rate today?
It's right about 6%. And some of the underlying figures, if you look at inflation, there's a whole bunch of things that get tracked underneath it. It doesn't look to me like it's going to be dropping as fast as the government says it's going to be dropping. The government's saying they're trying to get it down to 2% by the end of the year. I would be surprised, just looking at some of the underlying stuff, if it doesn't take another 6 months more than that at a minimum. But it's at 6%. It is trending downward. Yeah, let's leave it there.
Now, to understand, if you're on a fixed income, or the 6% inflation a year, it can be devastating. That is a significant increase, particularly if it happens year over year, year after year after year. So that's why they've got this focus on getting it down. The remedy or the approach that the government tends to take in reducing inflation is to increase interest rates.
Yes.
And restrict the money supply. I mean, I guess, and I don't know whether or not those two go hand in hand in your mind, or if they're kind of unrelated.
They're the same thing.
Okay. So the challenge with okay, and so the idea is, if I make money more expensive, that's going to cause companies to invest less, which is going to cause companies to tend to not, because they've got to pay higher rates of interest. They've only got so much money, so it tends to slow down employment. It tends to slow down their willingness to increase wages. And so they tend to put slowing down or reducing interest, it's slowing down and reducing inflation on the backs of workers. This is kind of ultimately where I'm wanting to take this conversation. But what's your general reaction or around this notion that, well, I'll ask the question differently. When, in your mind, because I gave my characterization of what happens when they increase interest rates, in your mind, or based on your analysis, what happens when interest rates are raised?
So I want to go back a little bit, because I want to add something to what you're saying.
Yeah.
High rates of inflation aren't just bad for people on fixed incomes. They're probably more detrimental to lower income people just in general, simply because of the things that tend to be going up in price right now are things like food, right, and gas. And if you're relatively low income, you spend a higher percentage of your income on stuff like that, or on housing. Whereas if you have higher income, the stuff that you're buying more of, relatively speaking, is not inflating quite as quickly. So inflation is, generally speaking, worse for people who are on low income, fixed income or not, than people who are high income.
Thank you. Thank you for the clarification.
No, yeah, no, it's not even a clarification. It's just adding on to what you're saying,
Okay.
really. I mean,
Yeah.
it's agreeing with you in a lot of ways. And so when you have a high rate of inflation, it's because there's a lot of money floating around in the economy. To reduce inflation, you need to pull money out of the economy. And the way that the government does that is through the buying and selling of government bonds. And now this gets wonky, and so I don't want to go too hard on this. But the way for the government to pull money out of the economy is to raise interest rates so that people will stop borrowing from them quite as much, right? Like, or lending to them quite as much, right? The money flows into the government instead of staying out in the economy. And so that's what they're trying to do, is trying to get the money out of the economy. Now, is the effect on employment an intentional effect? I would say the answer to that is absolutely not. They're not trying to increase unemployment. In fact, the Federal Reserve has what is we call the dual mandate. They have two things that they're supposed to do: keep inflation low and keep employment high. The problem is that oftentimes you can't do both at the same time, or when you're trying to fix one thing, you cause a problem with the other thing. And I think the other point we really need to point out here, or I really want to point out, is that the government has put itself into a position where all of their options are bad, right? Like, inflation is high. They screwed up in a number of ways that generated this. And so their options are bad, right? Every option. It's either let inflation stay high, it is, or you start bailing out banks, and that creates bad incentives for future banks, or you're going to do things that are going to be detrimental or harmful to the lower income individuals in society. Sadly, they generally choose rich friends as opposed to normal human beings. But that's something that governments generally do. And so it's unfortunate, but that seems to be the way that the government usually does it.
So when we talk about this dynamic of inflation, we've seen over this period of time that a lot of major corporations have had record profits.
Sure.
So wages have been going up, but profits have been going up.
Mm-hmm.
I heard a very interesting argument in a podcast. Why is it there's never any conversation about, well, let's cut corporate profits, or let's do something on the corporate profit side that is impacting inflation, instead of things that tend to specifically hit workers? Is that just a completely bizarre idea, or is there some way to split that up in a way that's different than how I've asked it?
I hear what you're saying, and I sympathize with where that sort of question is coming from. I get concerned when I hear these sorts of arguments that they're coming more from a side of a politically slanted viewpoint, as opposed to trying to understand the true economic possibilities in
Perfect.
place.
Okay.
So we hear things like, all right, companies are having really, really high profits. First thing we need to ask is, are these in nominal dollars or real dollars? That's wonky question of, are they having high profits because inflation is making all of the price numbers higher, or are they having high profits because their margins are high? That's never a question that's being asked, right? And so for those of you who are like, what did he just ask, right? If the price of everything is going up, right? The price of the things that you're buying as a business are going up, and the price of the things that you're selling as a business are going up, and every price is going up, but you're profitable, that means that your revenues have to go up faster than your costs,
Right.
just by definition. Therefore, profits are going up by definition. What we really need to ask about is, all right, profit or revenues divided by cost, is that changing? And the answer to that is nobody's asking that question. And I don't know if it's because nobody wants to ask the question because they don't like what the answer is going to be, or if that's too wonky for normal people to really get their hands around. But that's the question we need to be asking. Second thing I'm worried about.
Yeah.
We're really focused on a couple of industries. We're focused on, well, look at oil and gas industry profits. Well, that is a small part of the market, and we wouldn't talk about inflation being one particular product. So we shouldn't also talk about, oh, the profits of oil and gas being representative of all the industries across the world or across the country. Um, are profits going up? I suspect there's an element to which they are a little bit. And again, this goes back to how the COVID pandemic and the bailout that came out from that impacted businesses. Basically, it was easier to be a big business during COVID than a small business.
Without a doubt.
And the reason why, and I know you're a small business owner as well, and you've talked about your restaurant multiple times, right? The process of turning your restaurant into a digital service was probably about the same as the cost of turning Burger King into a digital service. The difference is that Burger King can spread that cost out over 4,000 restaurants. You're one dude, right? So to you, it's a bigger share, a bigger chunk of your business. So it's going to be a big hit on the little guy. And we wound up really creating a market in which the big guy got bigger. And so I suspect that there's an element of us seeing that in these sort of profit figures. But again, that's kind of a different phenomenon, right? Than the than sort of saying, all right, we have inflation because businesses want to get richer. The other,
go ahead. Yeah, so here's how I want to say it exactly what you said differently, but I think you're spot on. So when COVID hit, and this question of being big versus little, right? A lot of little guys did not know how to pivot. They did not know how to change their business model to match the new reality. So the people who did ended up with bigger market share. Mm-hmm. They ended up with more revenue, more opportunities because companies were failing because they didn't know how to make the adjustment. So of course, if you suddenly got this big inflow of opportunities, you're going to make more money, particularly if prices are going up. You're even going to make more money because the one thing that wasn't rising was labor. The cost of labor wasn't going up. So if everything else is going up, but your cost of labor is not going up, you're going to make a profit. Now, what's interesting, speaking about my restaurant, where we did not do any delivery apps, we didn't have Uber Eats, we didn't have Grubhub, we didn't have Dobra, we didn't have any of that stuff. We knew how to pivot. Within 60 days, we went from not using any delivery apps to having all the delivery apps. And we saw a 40% increase in our revenue stream, and we made a lot of money. And so we actually, because we were small, were able to pivot faster than the big guys. A lot of big guys could not move that quick, not across thousands of stores or whatever. So it really does come down to, yes, size without a doubt helps, but the ability to have agility built into your culture is probably more important than any single thing that anybody could have. Can you respond to the uncertainties that take place? There is profitability in being able to be more responsive than your competitor.
Yeah, so that's the advantage of being small is your nimbleness.
Well, it's not an advantage. Small is being not an advantage if you can't pivot, because lots of small organizations could not pivot.
And the only difference I think between your sort of explanation and my explanation is that I'm sort of opening a slightly different door, which is it's not that they didn't know how to pivot, it's that pivoting was way more expensive for the small guy than the big guy. Mm-hmm. And so maybe they knew how to pivot, but they couldn't afford it because it would have been way too big a chunk of their revenue, right? And it's probably the case that you're a smart dude, but you also are probably running a fairly profitable business to begin with, so you could afford to eat that short-term cost of making all these changes. If you were just kind of on the border anyway, that was probably the death knell for your business. Even if you knew to pivot, you couldn't have afforded.
You make some great points, and we would end up moving away from economics to operational factors. But let me quickly say that the genius in that restaurant pivoting, I'm going to give it all the credit to my son, not to me, okay? Because he was the person who, I mean, I put all the delivery app stuff in place, but he's the person who figured out how to actually get it done. And what was, truly remarkable, and I always make this one point because I don't want to move away from economics in our last few minutes here, is at the same time as that happened, all the employees left because they were afraid of getting COVID.
Yeah.
So we had the double whammy of the customer wasn't coming through the door and the employee didn't want to work.
Were you in the kitchen, Darswell? Were you
No, I was in North Carolina. He was in the kitchen, but literally, what happened was he told me he could run that place by himself. He said the customers who want to come, I'll have all the food ready, and they will wait for me to prepare it for them because there aren't options.
Wow.
And so he said, I can run it. And he ended up not running it. I don't think he even ran it a full day by himself. Because what happened was they simultaneously shut down the theater district. And he had a bunch of buddies who were in entertainment whose income shut down and they needed to work. And so he literally had guys who were in the entertainment business call him up and say, if you're open, can I work? Because I need to pay my bills. And so literally there was this transition, and then a couple other people a few days later said, I guess I need the money more than I need to be worried about my health. And then all these protocols came into place. But that's what happened. And so and by the way, somebody could have looked at our business and said, hey, you guys made a whole lot of profit in the middle of COVID.
Yeah.
What was that fair? How come you were? It's very the wheels are spinning in my head now, recognizing how COVID, because of his ability to first off say, I'm going to figure this out, and then the realization that you had to just find you had to find a different staff. You did. It's crazy.
And if I can bring this back to the economics that we
Yes,
started down,
please do.
This is, I mean, you say this isn't economics. This is economics, right? This is awesome. But part of profit is the willingness to take on risk. And we look at the situation that your store was, and we look at it after the fact, and we don't realize all the risks that went into it, right? We don't understand, like we don't appreciate the fact that your son is there every day risking COVID, getting COVID in an environment where we didn't know how bad it was, right? We got people who you're putting up money to sort of change over your business in 18 different ways. And we didn't know if it would pay off, or you didn't know it would pay off. And we look at it now, we're like, well, of course it paid off. It was of course the right thing to do. Why should you be compensated for doing the right thing? But who knew what was the right thing to do 2 years ago, right? If COVID was over and done in 14 minutes and you dumped all this money into all this infrastructure, you made a dumb decision and you're bankrupt right now.
I'll tell you what's really fascinating about this, because during COVID, the federal government was giving away money, as we've talked about. Hey, they're giving away money. They're giving away money. We didn't qualify, and to this day, I have people calling me up saying, "Hey, there's $26,000 per employee that you can get back in a payroll tax reduction if you continue to pay somebody during the downturn." And they're like, if you had a loss in revenue, then we'll give you. They're still trying to give us money, but we don't qualify because we didn't have a downturn in business. Our business grew during COVID. Actually, coming out of COVID, now that you can go back into a regular restaurant, now our revenue is down, because people can go back and sit in a restaurant, kind of like that. Oh, because it had a crazy spike in business because we knew how to pivot back then. Now the question is, how do you pivot? What's our new reality, right? Because we've decided we don't want to allow people back in the restaurant. We liked the production business a lot more than we did having to deal with that customer day in and day out. So we're now having to pivot into I'm not going to belabor this point, but it's just fascinating. And our pivot into COVID was better than our pivot has been coming out.
Right. Well, and think about all the other restaurants in the same position, right? All of them now have to come up with a new pivot. What's the right pivot? Who knows? Everybody's taking a different risk. And in order to ensure that people are taking risks and are trying to do things that are innovative, the only way to ensure that is by having profit. Profit is it's like the carrot that's dangling at the end of the stick that you're trying to get the donkey to chase after, right? And without that, businesses don't innovate, industries don't, stagnate.
Right.
And I mean, profit is a dirty word in the American lexicon. To me, profit is the only thing that keeps the economy going forward.
If you don't have profit, you don't survive. And if
Yeah,
you don't have profit, you're not a free enterprise society.
yeah.
I want to give us in the time we've got left, I want you to help folks to understand. You talked about the risk of stagflation,
Right.
that what we're looking at here, given all that's taking place, is stagflation. So that's having a stagnant economy while prices are still rising.
Rising quickly, yeah.
Rising quickly. Thank you. What is the chance that we end up in that situation in your mind? I don't know. Maybe that's a percentage question.
Yeah.
And then if you're sitting in control of the levers, what would you be thinking about doing right now versus perhaps what is taking place?
Man, I am not in charge, so I haven't thought too much about that second part of the question. I might punt on that, but maybe we'll see if I can come up with something off the top of my head. With
Okay.
regard to the first question, how likely is it? I would say America is probably 50-50. I would say if you look at Europe, you look at Latin America, it's higher than that. We have a better, sort of a more stable underlying economy just to begin with. And a lot of what's going on with regard to why you would see the stagflation is you've got the really large government services that grew during COVID and very rarely get peeled back, like just ever, are going to be a drag, generally speaking, on the economy. The things that drive economic growth are innovation, are private businesses, and things like that. And we need those to be profitable in order for social programs that the government operates to have enough revenue to run on.
Right.
And so it sort of changed that dynamic from, lots of private enterprise, small government programs to less free enterprise, more government programs. You're kind of, milking the cow more frequently. That's not even an idiom that people use, but like, you're gonna dry up the golden goose that lays the
Gotcha.
egg. You know what I mean, right?
Yes.
Um, and so I think that if you look overseas, there's a bigger risk of that. Uh, in America, it's really tough to tell, and I think a lot of it has to do with, are the financial markets going to sort of cascade, and we're going to continue to see what's, the SVBs and the signatures and whatnot, or are the recent things put in place going to sort of stem the tide, and maybe we get lucky and get a soft landing? Now, I think last time I talked to you, I was a little bit more optimistic about soft landing, and I am not as optimistic as I was before.
That's got to be the last word. We've come up to the end of the hour. Matthew, thanks so much, Matthew Dobra, for coming